July 17th, 2024. Today I thought was a pretty unusual day. We had a really large gap down. And, if you've ever seen Al's encyclopedia, if you own it, you should look. There is basically a big section on gap downs, and what a gap down usually does. And, what the Bulls want is, well, it's kind of they want a better version of what they got. But what the Bulls want is a really big looking bull bar on the open, closing near its high, and they want to be able to buy above it, betting that we're basically just going to rally all the way up to yesterday's low, which would be here. So when the Bulls see bar one, they're hoping to get another big bull bar that looks like one and basically just get a bunch of follow through. The Bears were looking for some sort of low two on the open or low three. Usually it pulls back to the moving average. You could sell this, but I would, honestly just rather wait until we get to the moving average. So it was a bit difficult to take this type of short because you are so far below the moving average that it's really hard to trust that sort of thing. But anyways, Al's encyclopedia has a big section on wedges. So you get a big gap down. A lot of times you get a wedge or a low two to the moving average and then a sell off, or you get some sort of wedge or low two down and then a bounce to the moving average. And occasionally you'll get bull trend from the open or bear trend from the open, but it's just basically a big section that shows you the different options and how they look. So that's a pretty helpful piece of the encyclopedia. So bar one was a really big bull bar, but there's two glaring issues I have with bar one. And one of them is the fact, if you look at where the bar opened, sorry, let me just get this the way I want it. If you look at where the bar opened, the open of the bar was actually the low of the bar as well. And whenever you get a day where the open is the high or the low of the day, really only about 1% of the time is on any given day is the open of the day going to be the high or the low. And this is all sampled data, right? So you can't actually know for sure if this was the high or the low because, normally if you look at CME, which is basically the company that runs the entire Emini, you can just look at cmefutures.com. That's what I go on. And it doesn't normally matter, because on CME, if the bar was one tick higher or lower, it doesn't usually matter, and it's unusual for it to be different. It's usually exactly the same. However, this is a really, really important thing. So if the open of the day is the low of the day, again, that only happens like 1% of the time, the low or the high of the day. So that's a pretty unusual pattern. So I went and looked on CME this morning, and it was in fact the low. So the low of this bar was the low of the day on CME, which is they make the prices. So that's my first issue with this bar is only, very, very few times a year, once or twice a year, is this actually going to be the low of the day. So that thought made me think that there was an increased chance that we were going to trade below bar one at some point today, which is one of the reasons I did not buy it. Additionally, there's a tail on the top of bar one. I did have bar one marked as a reasonable buy because at the end of the day, it is a big gap down and it's a big bull bar closing near its high. But in this context, you probably would rather see the bar close on its high, not just near its high. And so this tail, if you were watching, you probably had it closed, a little bit higher, a couple ticks higher, you probably wouldn't have even noticed it. But this tail was bothersome because this is going to be the start of a big bull trend. Why is there a tail on the top of bar one? So those two factors kept me out from buying bar one and probably kept a lot of traders on the sidelines, which is why bar two ended up happening. Bar two, it's a low one short for the Bears. They're hoping that this is a big gap down and bar one is a pullback and bar two is going to be a low one short. And they're hoping this just sells off into a big bear trend. It's not very likely to do that. I think we need to get to the moving average first. I'm interested in buying, but I'm not interested in buying up here. I want to buy a reversal up from down here. And I'm interested in selling, but I'm not interested in selling until we get a pullback to the moving average. So I would say stuck on the sidelines. One of the things that traders will also do, they look at bar one, they see the issues with bar one, but they still think, well, pretty good looking bull bar. We're probably going at least a little bit higher. So instead of buying directly above the bar, as I've mentioned before, they'll just look to buy a 50% pullback. So instead of buying up here, they see the problems with the bar and they think, yeah, this really isn't all that great. I'd rather just buy the pullback. So they buy during bar three as the market pulls back to the 50% pullback of bars one and two. Bar four, big tail on the top, probably sellers not too far above bar three. The bulls, it's a high one above bar three, and they're hoping we're going to rally. But the reality is we're probably not going that much higher. When you're going to get these bull trends from the open after big gaps down, they're usually pretty obvious and pretty immediate, or you get a deep pullback, right? Because traders, look at this, they're buying the pullback. They bought the 50% correction. They didn't buy directly above the bar. That should immediately hint to you that this is probably more of a trading range than it is a bull trend from the open. So sellers above sellers above 3 during 4 triggers the high 1. A bull bar closing basically near its midpoint on bar 4. It's really not all that good. The bears are hoping it's some sort of double top, 2 and 4, and neckline the 3 low, but it's not worth selling anything here. We need a deeper pullback first. And it's not really worth buying anything here because this seems like a trading range open. And in trading range opens, your instinct should be to buy low. So you want to be buying reversals up from down here. 5, another bull bar, but a big tail on the top. This looks like leg 1, pullback leg 2. So what are the bears hoping? They're hoping that this big gap down is the start of a bear trend, and we have a 2-legged pullback, and then they want a bear bar closing near its low, which they got, and they want it to be the high of the day, which it was. So the bears got what they wanted out of bar 6, but bar 5, again, just setting up some sort of low 2. I don't know if it was any sort of leg 1, leg 2. Maybe. Yeah, pretty similar. So the height of this bar on the start of the second leg, something like that. But anyways, you don't really need to know that. It's just important that it was a 2-legged correction. Bar 6, a bear bar closing near its low. It's a low 2 on the open, so low 2s on the open. Pretty common pattern. High 2s and low 2s on the open. I have a whole big thing on these, but I should have more of the failed examples. There's a lot of examples though. High 2, you can see it didn't quite reach the moving average there. High 2 on the open, didn't quite reach the moving average. But the contexts are often, this is another good example. It did not reach the moving average, but you can still buy for a possible low of the day. I don't know. Let me see if I'm being biased. If you use the on Thinkorswim, the -/ES, it'll be it'll just show you the opposite of the chart. So this is what it would look like if it was the bull day. Yeah, I don't know. Maybe I would have sold, or maybe I would have bought had it been a bull bar. This looks better to me than it does on the bear side because your brain is naturally. I think we're wired to believe in the bulls a little bit more overall than we are to believe in the bears, considering the fact that there are more bull days every year than there are bear days, just by the fact that the market always goes up over time. So you're going to be a little bit, believing a little bit more in the bulls usually than you are going to be in the bears. But anyways, bar 6, a low 2 on the open, but I don't really want to sell. We're so far from the moving average that to me, it's really just not worth taking any shorts here. I think I'd rather wait. 7, big follow through for the bears. So consecutive bear bars closing near their lows. But to me, I'm just going to wait. I'd rather not be in this. It's so climactic, 6 and 7, and we're like 30 points away from the moving average. So when we're that far away from the moving average, I personally just prefer to sit out of the trade. 8, more follow through. So we have 3 straight bear bars, but I have a lot of, the big problem I think with 8 is that it traded below 1 and never pulled back to it. The bulls who bought below 1 are going to make money. This is a really big bull bar. So it'd be really, really unusual for the bulls who bought below a big bull bar to end up losing money. So when you get these consecutive bear bars closing near their lows, yes, it's always in short. Yes, it's sell the close. But it's really hard to take these sells because you know that there's going to be buyers somewhere below here. And again, I just don't want to trade when we're 20 plus points away from the moving average. That's just not something I want to do. I suppose if it was here, it would be right here. So we were 28 points away from the moving average. I just don't really have any interest in taking a trade there. 7, so 8, more follow through for the bears. So 3 straight big bear bars closing near their lows. I think we're getting a little oversold. The gap down was a lot. It was over 1%. And we now have 3 giant bear bars closing near their lows. And we are now, 36 points away from the moving average. So I am not selling down here. There's no chance. I think this is, if anything, you're buying at close of bar 8. These are huge climactic bars. You're so far from the moving average, you're going to pull back to it at some point. So it's not really worth doing anything here. I assume the bears were able to make 20 points. No, they were not. Okay, interesting. The bears who sold below 6 were not able to make 20 points before the reversal up on 9. 9, a reversal up. It could be argued as a high 1 and a big high 2 on the open for bar 9. But the problem with 9 is the tail on the top. If this is going to be the low of the day, why is there a tail on the top? If bar 9 closes on its high, it's a credible buy for a possible low of the day, and you can just take a chance. However, you don't really want to buy when there's a tail on the top here, because if it's the start of your strong bull trend, why is there a tail? So what will traders do? Well, instead of buying above 9, they'll wait to see if 10 is a good bull bar closing near its high as well. If it is, we might have to bounce for a little while. Again, we're oversold a little bit at this point. I think it's not, we're oversold in the context of the 5 minute chart and the past, 20-ish bars on the chart. This gap down is huge, and then we have three straight bear bars. So we're oversold a little bit on the context of the 5 minute chart. I don't mean, on like the daily chart or the weekly chart. We're nowhere near oversold on the daily or weekly chart. But I just thought that, maybe a little bit on the daily chart. No, not really. We're probably going to go a little bit lower. Whenever you get a bull bar and then the next bar gaps down strongly and becomes a bear bar closing near its low that does not overlap with this, there's at least I think I don't remember the exact stat, but it was something like along the lines of this. You get the bear bar, right? And then the bull bar has very little overlap. It usually leads to a swing up. So you can use the same logic here in thinking this will probably end up leading to some sort of swing down. So 10 consecutive bull bars, but again, why is bar 10 not closing on its high? It's really bothersome that 9 and 10 are not able to close on their highs. To me, it makes me think that this is going to become a leg in a trading range, and if you're buying here, you're now buying in the middle of the trading range. If you were looking to buy above bar 10, you were hoping that it was going to close on its high and be a low of the day. So you thought we were going to get some sort of attempt at a bull trend, but instead you're getting disappointing bar, disappointing bar. So to me, this is going to be more of a trading range. 11, an inside bar. It's a low one short for the bears. It's not really worth taking. I think that, spike, pullback, and maybe you're betting on a channel, but I don't know. I think it's kind of tough to take that short after consecutive bull bars. We might go a little bit higher before we go down. If we do go down, we probably should test back to the bar 8 close and the bar 8 low. The bulls had a chance to trap the bears on bar 9, but they're not doing a very good job. So that makes me think we're probably going to have to test back into this area, which we did and found buyers. 12 consecutive bear bars closing, not quite near their lows. Are we always in short? Yeah, I don't know if we really ever went always in long. The bulls, this is one of those days where I'm not really quite sure the bulls ever flipped the market to always in long. They had a couple of reasonable attempts to do so, but I just don't think they ever quite got it done. 13, an outside up bar, triggers the high one for the bulls above 12. So what are the bulls hoping? They want this to be the new bull trend, and then we get a pullback, and they're hoping that this is becoming a high one above 12 in a bull trend. But instead, it closes like this, and it's really not worth doing anything. That's a really disappointing bar, I think, if you're a bull. 14 trades below 13. Probably buyers not too far below 13 since it's a bull bar. We're probably going at least a little bit lower, but I don't know. Does this look like a bear trend to you, or does this look like a leg in a trading range? To me, I thought this whole thing looked like a leg in a trading range. So I thought for the most part, we were going to get a bounce today. I thought maybe 70% chance that we were going to get some sort of swing up attempt later today. And I don't really know if we got it. I thought that there were a couple of reasonably good chances for the bulls, but they just never really ended up getting the swing. I thought that the target for the bulls, if they started to get a swing, at least at this point in the day, was going to be the bar 10 close, because you can see spike, pullback, and then this would be the top of the channel right up here. So spike, pullback, channel, and the start of the channel is up here. So I thought it was possible. We might have to test back up in that area. 15, an inside bar. It's, potentially a high 2 for the bulls. So high 1 above 12, and then a high 2, 15. And they're trying to basically say that this is the breakout and we get a two-legged correction and we're going to get a swing up now. Except why is 15 not able to close on its high? This whole day, pretty much, the frustrating thing this whole day was every side just did not quite do enough. So that was pretty much the common theme today, was both sides trying to do enough and neither side really being able to do so. 16, a big outside down bar, a bear bar closing near its low, but I don't want to sell down here. I think that there's going to be profit taking in this area, which is only a couple points below here, and your risk is relatively large. So I would just rather sit out. Odds of you getting a big climactic sell off down here, which will make selling 16 worthwhile, are not very good. Big bar, big risk. I'd rather wait. Yes, we're always in short, and yes, it's a bear bar closing near its low. But again, you got to use the context of this looks like a leg in a trading range, and this could be 1 pullback, 2 pullback, 3 legs down. So to me, it's not really worth doing anything in here. And that's why you get disappointing follow through on 17. No one's really willing to sell down here. Traders are waiting to buy back shorts when we get back to this point. Bulls are hoping it's some sort of wedge, 3 pushes down, and they're going to get a reversal up. But we're probably not gonna. If you bought above 9, you're probably going to end up getting stopped out pretty soon here. 18, and you can see we traded above 17 and failed because it's bear bar. No one wants to buy above the bear bar. And you can see on 19, we traded back to the price where the bears who sold below 8, they got trapped. They scaled in maybe at 50%. somewhere up in here, and they scaled in, and now they're having getting a chance right here to buy back their shorts during bar 19. So they're going to do that, and that's what's causing 20. 20 is interesting. It's a truncated wedge, 1, 9, and 20. You can argue it's a lopsided head and shoulders, but it mostly means the same thing. Had 20 had, let's say we got some sort of higher low in here with around the same low as this, that would be a more applicable head and shoulders name. But it's the same forces for a truncated wedge and head and shoulders, I believe. But this makes more sense to call it a truncated wedge on par 20, which basically what a truncated wedge means is that, you had the first two parts down of the wedge, bar 1 and bar 9, and the third leg in the wedge was not even able to fall below the prior leg because traders were so eager to buy. So I thought it was reasonable to think you were getting a truncated wedge on bar 20 and take the buy for a swing. But you get disappointing follow through on 21. 21 trades back to the bar 19 close. And why are there buyers there? Well, there's two reasons. There's the bears who, maybe sold the close 19, disappointed. It's not really a good reason to sell the close of 19, but it's bear bar closing below its midpoint. And also the bulls know bears will be buying back shorts down there. So they'll buy with a limit order around the 19 close during 21. And what they're doing is they're taking a chance that this is a really strong magnet and that we're probably going to at least get pulled back up to the bar 20 close. What they're hoping is that we end up getting, maybe not on 21, but on 22, a really good looking bull bar, and we start to rally. But they know that that we're probably going to end up going a little bit more sideways first. But they also know that they're only risking 2 or 3 points. So it's a low probability trade to buy on the limit order as 21 is falling. But you only have to put your stop below 9, and you can try to make, at least double that if you get back to the bar 20 high, which we should. And who knows, maybe even if we get up here, you can make 5, 6 times what you would lose on the times that you lose. So that's why there's bulls willing to buy around the bar 19 close, and that's why they're stepping in there, causing the tail on 21. It's not worth selling below 21. We're going to get a second leg up from bar 20. It's a really big and strong looking bull bar, so it's going to get a second leg up. 22, a really good looking, 22, a bull bar, but it's not very good looking. There's a big tail on the bottom, and the tail on the top is what's bothersome. Another problem with 22 is that it's offering you a better entry price than the buy on 20. 20 was the better looking signal bar at the worst price, so second entries are supposed to be higher probability. So does it make a lot of sense in this context for the second entry to be offering you a better price? No, not really. To me, I think that, if we were going to rally, either we would have done it here or bar 22 would have closed above the bar 20 high. It was kind of similar to this, what I was talking about over here. Traders wanted this bar to close above this high, making sure traders had to get in at a worse price, because if they were offered the same price or better, it would be suspicious. And that's exactly what happened here. 22 is suspicious because the bar, A, has a big tail on the top, and that's not what you want. And B, it's offering you the better price than it did on bar 20. So most traders are, not going to take this buy. And instead, you can see traders just use the rally on 22 and 23 to exit their longs. And that's what causes 23, bear bar closing near its low. Can you sell bar 23? I mean, probably. It's a low 2. And we're always in short, but what's your win potential here, right? Like, what are you thinking is going to happen? We're probably not going to get a collapse below 23. We're probably going to go more sideways first. Again, at this point in the day, the bears are not doing enough. Granted, the bulls are also not doing enough, right? So the bulls did not do enough here. They did not do enough here. So there's no good follow through for the bulls. What do the bears want? They want to break out below this wedge and to get a measured move down. We didn't quite get to the measured move today. The measured move target would have been down here, but I thought it was reasonable to think we were going to try and get down there. 24, a second reversal up. I think 24 is the chance for the bulls. It's probably the problem with 24 is you're buying high in this tight trading range. So you have a tight trading range here. And if you're buying with 24, you're buying relatively high in the tight trading range. So what does that mean? It means that it's probably not going to go straight up. It's probably not going to trade above 24, and we're going to start this big bull trend day. But I think that 24 is strong enough for a second leg sideways to up. And I don't know how it's going to look, but I usually, we're going to go up for, an hour or so and start to bounce. And it doesn't mean we're going to go very far, but I think it's reasonable to buy above 24, expecting that we're going to get a bounce. And you just kind of see how the trade pans out and see how it looks. Disappointment 25 is not surprising. When you get the big bull bar closing near the top of the tight trading range, what do traders do? they prefer to buy a 50% pullback. So that's what they did on 25. They thought 24 was too big of a bar, and so they used the pullback on 25 to buy instead of buying directly above. Additionally, anyone who sold below 23 is disappointed in 24, so they're going to use 25 to buy back their shorts in here. An inside bar on 26, bulls, they want this to be the bull breakout to get a high one here. It's not a very good looking bar, but your argument for buying in here is not that it's wildly overly bullish. It's that it's just not that bearish, and we have magnets above, and we can easily bounce here. So that's more of the argument for the bull case here. It's that there are magnets above, and the bears are not doing enough to make this go down all day. So it doesn't mean we have to reverse here, but 24 is a second credible reversal up. And usually when you get two credible reversals up, like we did 20 and 24, traders will not take the third reversal if the first two fail. So you can see 20 failed and 24 failed, and then we got another reversal up 29, but most traders were not willing to take that. A lot of times when you get a failed breakout, or when you get a breakout below two credible reversals, you end up getting some sort of measured move down. So I thought on 32, 33, I thought 32 was probably the best trade of the day. Just taking a chance that we're going to start a collapse. And you can see we never got it. We got a reversal up 34, which was very problematic for the bears, hoping to get a collapse. But it's not worth buying 34 because, again, you need to wait for a new pattern. It's not worth betting on bears getting trapped when they had a lot of chances to get trapped in here. So it's not really great to be buying above here. It's probably better to buy the second reversal up because you're waiting for a new pattern. So it's probably better to buy the second reversal up above 40. But anyways, 27 outside down. This probably shouldn't happen. I think if you're going to bounce, it's going to look a little bit better than this. So 27 is a bit of a disappointing bar. And then 28, an inside bar and a bear bar closing near its low. Are you selling below 28? I don't know. I mean, you probably can. It's a low one short. And you can take a chance that we're breaking out. We're going to break out below the low of the day and start the collapse. But instead, we get to the new low of the day and get another reversal up 29. But I'm not buying 29. It's a doji bar, and I think the context doesn't really support this reversal anymore. Thought that if we were going to reverse, 24 was probably the last chance for the bulls to get the reversal. I don't really see why we would reverse now. 30, more follow through for the bulls. So we have consecutive bull bars. So we have consecutive bull bars, but again, I think they need one more bar to make the market clearly always in long, and we haven't really done a good job at going always in long today, so I'd rather wait. An outside down bar 31, but not able to close on its low. At this point, again, the bulls, I'm not really willing to be long here. I think the bulls have done, gotten a couple of very credible reversal attempts, and they haven't done anything with them, so I'm not taking anything here. And then 32, a bear bar closing near its low, reasonable to sell. You could argue some sort of low too, but really we got near the moving average, and now you have consecutive bear bars closing near their lows. Additionally, we haven't been to the moving average yet today. And, there's a 99.5% chance that you will get at least one close above the moving average on any given day. There's a 99.9% chance that the market will touch the moving average with, tails at least 3 times. So that 99.9% chance we're going to touch the moving average, which at least 3 tails, and 99.5%. You can just think of these things as guarantees because it's going to be so rare that doesn't happen that it's not worth considering. So it's not 100%, but you can just think of it as 100% chance we're going to get a close above the moving average today because, again, you're going to literally be right more than 99 times out of 100. So it's really just not worth considering the alternative. 33, so consecutive bear bars closing near their lows. This could be the start of a collapse, I thought. And what would the target of the collapse be? Well, I thought the measure moved down. We would have been a reasonable target for the collapse. So we get 1 or 2 more big bear bars closing near their lows, and then get somewhere down here, and then start to reverse up, maybe around bar 35 or 38 to 40, and get some sort of midday reversal. So I thought we were going to start to collapse here. Instead, you get 34, a bull bar closing near its high. Will bulls buy betting bear trap 32, 33? Maybe. I think it's more of a bar for bears to exit their shorts than it is for a bar for the bulls to buy. It's still possible that that we get a reversal up, but I don't think that we would do it now. I think we need to wait for a second reversal because bulls had so many credible attempts up. It doesn't make sense for the bulls or for the bears to get trapped selling after the bulls have already had a couple of credible reversals. So probably not worth buying 34. The bar looks good, but I don't think the context just makes a lot of sense for 34. If you're going to do it, probably have to have a wide stop. 35, a bear bar closing somewhat near its low. It's a low one short for the bears who sold below 32 and 33. If you're always in short, you probably have to sell again below it. And there's nothing wrong with selling it. You definitely can. But at 34 is such a problem. Why did we get a bull bar closing near its high if this is going to be a bear trend? I don't understand why we would get that. So, yes, we might still start some sort of collapse, but for me, this was really sketchy that we got the bull bar on 34. 36 consecutive bear bars closing near their lows. So we're clearly always in short. It's okay to be short, but 34 is still suspicious. So you're hoping for a pretty strong breakout relatively soon here if you're short. 37, a doji bar. It's follow through for the bears, but it's really not that good. Again, this is probably going to come to an end relatively soon. So at this point, you got to be thinking, well, we got 40, 50 bars left in the day. What are we going to do for the rest of the day? Probably, obviously there's the three options, right? We get a bounce and then we get a sell off. We get a bounce and go sideways, and we get a bounce and go up. Why do we have to get a bounce? Well, we have to get a bounce because we're going to get a close above the moving average. So it doesn't mean we have to get a bounce right now. We could keep selling off, but we're going to end up getting a bounce today because we're going to get a close above the moving average. The days where you don't get a close above the moving average also do not look like this. They're really strong days the whole day. This to me is making me think we're going to get a swing up at some point today. 38 consecutive doji bars, so really not all that great for the bears. We might continue down, but I'm not sure how much further. And 39 is an inside bar, so a low one short for the bears on 39. An inside bar, which, low ones are okay in the spike phase of the bear trend, but they're really not all that great when you're selling this low. It looks more like a final flag. And then a reversal up 40. You can buy above 40. The reason is, the bears are going to give up. We've had 2 attempts down now. The first attempt to 33, and it didn't do that great. The 34 was confusing, so some traders exited, and they sold again below 35, 36, hoping that the sell-off was going to continue. And then they see 40, and traders are just going to dump, just buy back their shorts, out of frustration. And you can see 41, it moved really quickly. It got basically like, it was up here, and basically in like 1 second went from here to here because bears just bought back their shorts at the market, and they said, I'm done with this trade. We're not getting the sell off. So we're going to the moving average now. So 41, a big bull bar. Are we always in long? I don't know, maybe, probably, but it's not really all that great. We're probably going to find sellers that first time we get to the moving average. When you get a gap down, we've been below the moving average for 41 bars. Algorithms are going to sell the close of the first bar to touch the moving average because there's probably going to be sellers there. It's the first time all day that bears have had a chance to sell at an average price. So a lot of them are going to do it. And so when you get follow through 42, it's, 3 straight bull bars. Yeah, good for the bulls, but it's enough for a second leg up. I don't think we're going straight up here. I would not buy the close of 42. I'd rather just wait. And if you bought above 41 or you bought above 40, you probably just take profits. And, I assume, I don't think you made 10 points, but you made 5. Yeah, so it was a 5-point scalp buying above 40 to get to the moving average. I think if you're buying above 40, you're probably just taking your 5-point scalp at the moving average when you get it. So 42 gets to the moving average. 43, an inside bar, a bear bar closing near its low. Are you selling below 43? I don't know. I mean, I probably wouldn't. I think that I'd rather wait after 3 strong bull bars, but we might get back down to the low of the day because it's a gap bar. So it's reasonable to think we'll get back down. And then you get a huge bear bar closing near its low on 44. I'm not selling 44. This is way too big a risk, and you're selling low in what is now a trading range. Why is it now a trading range? This is not happening in a bear trend. We are not getting bars 40, 41, and 42 if this is a big bear trend. So we instead got 30, 43, 44, good for the bears, but we're already pretty overdone to the downside here. I don't think we're going lower. Same thing with 45. I'm not selling. I'm not willing to sell down here. Outside up 46, so good for the bulls, but disappointing it couldn't close on its high. We're probably going to start to go at least sideways here. I'd be surprised if there was much left to the downside. An inside bar 47, so an IOI pattern. Potentially some sort of final flag for the bears. I don't think we're going much lower if we trade below 47. You can see IOI patterns are breakout mode patterns, so we're in breakout mode. And then you get a bull bar closing near its high 48. It's a credible buy. You could make an argument that these 3 strong bars broke the trend line for the bears. You could say it was here. You could say it was here, but it broke some sort of trend line for the bears, and now we have a lower low. So you could argue that 48 is a lower low major trend reversal. So I think it's reasonable to buy above 48. Where do you think we're going? I don't know. You could take a chance for getting up. The magnets are the 42 close. That's the first magnet, which we basically got to, not quite. And the second magnet would be the bar 30 close. Where basically this sell climax high and then this sell climax high. So this area right here would be the next magnet, which is actually is where we got to. So you can buy above 48, higher low major trend reversal, or sorry, lower low major trend reversal. Follow through 49, but we're still within this trading range. You want, pretty good follow through on 50. Instead, you get a bear bar closing near its low on 50. This is a better example of a head and shoulders, left shoulder, head, right shoulder. So you can sell below 50, taking a chance that we get back down to at least the bar 45 close, maybe a breakout below the neckline and a measured move down of these three bars to somewhere down here. So it's a reasonable swing trade below 50. Problem is, we've gotten so many reversals up today. It's going to be hard for the bears to get a really credible swing down because we just keep getting reversals up. They don't really go very far, but it's still enough strength to make you think that we're probably going to go sideways. 51, disappointing follow through. Probably sellers above for a second leg sideways to down. You can see we traded above it on 52 and then got the second leg sideways to down on 53. 53, I thought, had we traded below 53, you could sell it as follow through for the bears, and maybe we're going to start the measure move down, but instead we get an inside bar 54, so it looks like just a second leg trap now. It's essentially a high two attempt at 54, but I don't know. I'm not too sure about buying at this point. The Bulls have had a lot of really reasonable looking attempts to reverse up, and they keep not doing it, so I'm not really sure there's much the Bulls can do to make me buy at this point. 55, a potential third push down. 51, 53, 55. Had 56 been an outside up bar closing up here, fine, I'll buy it, but that's probably the last thing I'd be willing to do today. And instead, you get a big tail on both sides, so no one's going to buy above 56. Doji bar 57. So disappointing. Again, we're just in the middle of a trading range at this point. You could argue it's a triangle, and 58 breaks out of the triangle, which is true, but I'm not buying 58. There's no way. This is a really big doji bar, and you're buying. It's not breaking out of anything. If you look, if you buy above 50, 58, it's not breaking out of the high of bar 50. It's not obviously not breaking out up here. So there's really just no reason to take that buy. You're buying. What you got to boil it down to is this trading range? Yes, you're buying a big bull bar at the top of the trading range if you're buying above 58. This is, it didn't even go that poorly for you. You got out with basically no loss, which is good if you got out below 61, which you should, but it's just not worth doing. And you get disappointing follow through 60. Sorry, on 59, you get disappointing follow through, which will make a lot of traders just exit the market. 60 buyers below 59 because it's a bad short because it's a doji bar. But the second leg up 60, we're probably not going that much higher. So possible wedge forming here. 1, 2, 3 on 61. You can sell below 61 for two legs sideways to down. It's not the smallest bar, so it's not as good as it could be, but it's still reasonably sized, and you're selling really high in the trading range. So the Bears have that going for them. It's possibly some sort of nested wedge, 46, 50, which is an overshoot, and then 61. 62, follow through for the Bears. So consecutive bear bars, but a big tail on the top. Again, expecting a second leg sideways to down. Sellers above 62 if we get there. Doji 63, probably going at least a little bit lower. How much lower? I don't know. Just get back into the lower third of the range at least. But again, even if it's at this point where this is the trading range, you can see how high you're buying. And if you're selling below 61, you're selling the exact lower third of the trading range, so it's okay to do. You could just do this and take profits when you get to the lower third. You're selling in the exact upper third, and you can just take profits when you get to the lower third. 63, a doji bar. We're probably still getting a second leg sideways to down, so I wouldn't really do too much here. 64, a bear bar closing near its low. Yes, good for the Bears. We'll probably go a little bit lower, but I don't know how much lower. 65, consecutive bear bars closing near their lows. Again, good for the Bears. We're probably going at least a little bit lower, but you're now selling low in the trading range. So disappointing follow through 66 and an outside bar 67 or reversal up 68. But at this point in the day, I'm giving up. I don't remember exactly when. It was somewhere in here where I decided I was done for the day because nothing was going right, and it started to become very clear. It seemed like the market was going to be bear trend from the open, and then trading range day. To be honest, to me, this was more of a trending trading range than anything. Usually in trending trading, it didn't look all that great, but usually in trending trading ranges, you get a trading range and then a breakout and then another trading range. And you could argue that this was basically just a trading range. Here's your breakout, and then we formed another trading range. So yeah, we had triangles along the way here. This ended up being a triangle, but I think it was okay to just it wasn't a very clear triangle, and I think it was okay to just classify it as a trending trading range day. For stop orders today, I thought you could buy above one, but there's definitely issues with it. Six is fine, but I'm not doing that this far from the moving average. Same thing with seven. I'm not doing that this far from the moving average. I would not buy nine. I thought 20 made some sense and 24 made sense too. 32 is a good trade. I would not buy above 34 because, again, too many reversal attempts up that looked better than this. So what's going on? 40, yes, but probably just take the 5 point scalp to the moving average. You've had 40 bars below the moving average. You don't want to be the guy hoping that we just start to get a straight rally. Uh, Maybe 43, but I don't know. I would rather just wait after three straight bull bars. I'm not selling 44 or 45. Way too big. You're probably going to lose. 48 makes sense. IOI breakout mode. You can buy that, but you got to get out below 50. You can probably sell 50 for a swing. And then other than that, maybe just 61, but that's not even all that great, but it's still fine. On the daily chart, so like I said, when you get this kind of pattern where you have a bull bar closing near its high, and then a big gap, and then a bear bar closing near its low, it means you're probably going to get some sort of swing down. The same way over here, this meant you're probably going to get some sort of swing up. Usually, obviously, this pattern works better for the bulls because the market always goes up over time, and usually they're bigger bars than this. You would want to see a bar like this, and you'd want to see no overlap with this bar. So you'd want to take this bar 1110 and put it right here on instead of 1030, and let's say it opened here. So there's a gap between this high and the low, and the bar looked like that. That would be the most bullish form of the pattern. So here it's bearish, but this isn't as huge of a bar as it could be, and this isn't a very big bar either, and we were relatively overbought. So again, to me, this means trading range. Where are we going to? First target would be this high, the high of 628, and then probably the tight trading range, I'd imagine, is still a final flag, so the breakout above it is failing. We're probably going to touch the moving average pretty soon here. But it doesn't mean that, we might end up going sideways for a few days because of how strong this has been. But it's been, I thought the trading range was going to start in here, and we've gone pretty far above that, which is surprising. But I think this puts a damper on the bulls' chances to get to 6,000 before we start to go sideways. And you can see on the weekly chart, like I mentioned yesterday, it's an important bar, and then so far it's a big bear bar closing near its low. The bears, I don't know if they want to drive the week outside down. It might be, I think it's better for the bears if it doesn't go outside down, because that way it's a smaller bar and they can just bet that this was a trap and that they don't want this to be their signal bar. So I'm not sure it's great for the bears if it goes outside down. But to me, it might be a more of a trading range price action type of thing if it does go outside down. And, bears obviously trying to put as big a tail as possible in the monthly chart. They'd like it to be a bear bar. Is that still doable? 75, 80 points, 100 points. Yeah, it's still very doable. We have plenty of time left in the month for that. We'd have to get pretty bearish pretty quickly. But yeah, the bears. So if we start to sell off, I would pay a lot of attention to the open of the month. All right. That's